Today, I'm going to prove to you how predatory lending not only affects penny stocks in the OTC market, but public companies and the entire equity market as a whole. So, taking it back to 2005, the SEC actually paid Leslie Bonney to do a full report on strategic delivery failures in our equity markets. So, the main thing that you have to take away from this is sellers of U.S. equities who have not provided shares by the third day after the transactions are said to have failed to deliver shares. Using a unique data set of the entire cross-section of the U.S. equities, we document the pervasiveness of delivery failures and provide evidence consistent with the hypothesis that market makers strategically fail to deliver shares when borrowing costs are high. That's interesting because we saw GTII and also finger motion had hundreds of percent, even up to 1,300% borrow rates. So that's very interesting. We also document that many of the firms that allow others to failure to deliver to them are themselves responsible for fails to deliver in other stocks. Shocking. Our findings suggest that many firms allow others to fail strategically simply because they are unwilling to earn a reputation for forcing delivery and hope to receive quid pro quo for their own strategic fails. So they want incentive. Finally, we discussed the implications of these findings for short sale constraints, short interest, liquidity, price volatility, and options listings in the context of recently adopted Securities and Exchange Commission regulations show. So there's many other things that we can go into this. It's 48 pages long. I'm just going to show you what I think you need to know, which is right at the end of the document. But of course, I'll leave all the links in the description. I want you to learn and read yourself, especially if you have interest in it. So at the end of the document, we see implications for Reg Show for U.S. equities. And it says we document prior to Reg Show, most U.S. equity issued, listed and unlisted experience at least a small percentage of failures to deliver each day. A substantial fraction of issues, 42% of listed stocks and 47% of unlisted stocks, had persistent fails of 5 days or more. About 4% of U.S. equity issues had fails and would have classified them as threshold securities with the mandatory closeout requirements under Regulation Show. We find evidence consistent with the hypothesis that pre-reg show equity and option market makers strategically failed to deliver shares that were expensive or impossible to borrow. This is really a key. I want to say this again. Okay, failed to deliver. We find evidence consistent with the hypothesis that pre-reg show equity and options market makers strategically failed to deliver shares that were expensive or impossible to borrow. I'm going to say that again. Strategically failed to deliver shares that were expensive or impossible to borrow. I wonder why. We also provide evidence that strategic fails, naked short sales, likely accounted for a higher percentage of short interest pre-reg show than previously understood. These findings support comments of the equity and market makers that the inability to strategically fail to deliver shares post-reg show will reduce liquidity and increase short sale constraints. So, liquidity will decrease and short sale constraints will increase. This is so crazy, particularly for stocks that are expensive to borrow. I mean, it's right in front of your face. This is exactly what we've been talking about the entire time here. This is why when people don't understand how this operates, the system has been well aware of this for a very long time. This is not a year ago, 2, 3 years ago. This is a very long time. And this didn't just begin here. Didn't just magically pop up in a report came in 2005. This had to happen for a long time before then for them to write a 48-page paper on it. As institutions are more likely to be lenders in the market for stock loans, stocks with little institutional ownership will likely become even less liquid. Stocks that trade over the counter, or OTC, pink sheets had average institutional holdings of only 1.3% shares outstanding for our sample period and are likely to be among the hardest hit. So, like I tell you, there is no institutional owners, no big fish, no volume in the stock. Why do you think that is? It's because it's being naked short, it's being attacked. And again, those are the ones that are targeted the most. Those are the ones that are likely to be among the hardest hit. So option listings will decrease for stocks that are expensive to borrow. Short interest will decrease, especially for expensive to borrow stocks. As a result, or in anticipation of mandatory closeouts, illiquid, expensive to borrow stocks may be more likely to experience temporary short squeezes and increased price volatility. Folks, the proof is in the pudding. This was paid for by the SEC, Leslie Bonney, 2005. Please do your homework. Next, we're going to talk about United Airlines and how they were a victim of naked short selling when they went bankrupt in 2008. So the stock nosedived $20 a year ago to $2 on October 8th, right after they filed for bankruptcy protection August 11th. Okay. So here's really interesting is in 1999, it was high as $80 a share, but now it says it's looking to see a surge in short activity. So again, such complicity among clearinghouses and hedge funds in allowing the shorts to unreasonably delay delivery of the shares that they have sold within the required 3-day period, it might launch a full-scale investigation. Here's the kicker. With bankruptcy in the air, the number of investors shorting the stock has swelled. Some 24 million of UAL's 56.9 million outstanding shares are now in the hands of shorts, plus many more unreported have been shorted through ECNs or electronic communication networks, which are computer-based trading systems, through the options exchange. What we know is when you sell a stock short, you make the difference from where you borrowed it, and then on the way down, whatever the difference is between the high and the low, you pocket that. But here's the rub. In this case, they don't often have possession of UAL shares they shorted. One of the ways they can delay delivery is to sell short through these ECNs because they are hard to track or police. Okay, they aren't members of the New York Stock Exchange, so they don't necessarily have to enforce its rules. This is crazy. And again, according to New York Stock Exchange regulators, a person selling shares short has to deliver the shares to the buyer 3 days after the trade date. However, extensions are usually allowed by the clearinghouses. This is not okay. So investors who are long say many shorts haven't actually delivered them, and I certainly believe that. So why does this happen? Like we mentioned, the clearinghouses at the big investment banks are supposed to have control over this activity and make sure that the shorts turn in their borrowed shares on time. But these clearing firms usually look the other way and give the shorts more time. This is crazy. And this is coming from a big investment manager who owns a huge chunk of UAL. This is a violation of the big board's rules, he argues, and in the current environment of investigators into corporate shenanigans, the exchange is being pressured by institutional investors and UAL itself to launch a full investigation. So I'll let you read more on that. I'll leave it in the description, but it proves we saw 2005, they're talking about it, 2008, they're talking about it. These are two solid documents that prove this has been around for a very, very long time. Last article I'm going to talk about is Dole Food and how they had way too many shares. Give you a little bit of background. In 2013, tropical fruit tycoon David Murdoch, who is the chairman, CEO, and biggest shareholder of Dole Food, took it private for $13.50 a share. This is an anomaly. It doesn't really happen often. The shareholders felt the price was way too low, and they sandbagged them by driving the value of the company down so he could buy it cheaper for himself. They actually ended up suing class action lawsuit and winning. This doesn't happen often, so I really want to stress that. So they went through it. They actually ended up having to be paid out an extra $2.74 a share plus interest, and there was a total of 36.7 million shares in circulation. So they had to submit forms, get lawyers involved to make sure that everything was done properly. And what they got back was over 49.1 million shares. That's substantially exceeding the 36.7 million shares here. So we talk about it. How is it possible? Naked shorting. Where's their proof? Right here. And over $13.50 a share. Okay, multiply that by almost 13 million shares. Folks, that's over $100 million. Where did it go? Gone. And it took years to figure it out. This was 2013, and the article was written in 2017. I reached out to Matt Levine, the author. He doesn't want to get back. He will not comment on it. I don't know why. It's really strange. But the biggest thing here, and we can go through the article and everything. I'll just make it simple for you. But what they did was it took so much time and energy to have to go back and look at the tape years ago. It was no way they were going to figure it out. So a lot of those people that had accounts with them, they may no longer have had accounts with them. The people may have died. They're no longer a seller in the market anymore. So this was a huge confusion, right? This was, bureaucracy and the legal process. It took a while. It didn't just happen overnight where they figured this out. So they actually, in my opinion, believe the DTC how to pay this out. I'm not sure. They don't tell you what what exactly happened, but it's really, really interesting. This is an amazing article. I've done a video on it. I'll leave the link again in the description for you to follow. Great, great article, and proves what we've been saying the whole time, is just because there's a certain amount of supply created doesn't mean that the share circulating has to be that amount or less. It proves it right here that there were way more shares in circulation than what was actually created. So let's shift gears here. I know everyone wants me to wrap up with GTII. We saw 74% short volume per FINRA, almost 2 million out of the 2.6 million total traded today. This is insane. The price continues to go up as they short more. It's actually the inverse. As they short less percentage, the stock price goes down. It's almost like it's backwards land or opposite land. It's really comical. But they're just keep digging themselves a hole more and more and more. And hopefully by the first 3 articles I showed you, you're starting to get it. Okay, now we understand why this is happening, because it's been happening for so long. Okay, this is the chart that I'm looking at. I have this nice little daily wedge or pennant. It doesn't look great. Okay, this is something I just threw together. What more makes sense is what this gentleman sent me, but really, really nice trend line. It finally broke out. I think we have the ability to really snap, especially if we get over that 620 level. I think it's going to be devastation for the shorts. They saw that the professional buyers coming in. They know that the company is in talks with possibly, putting out, positive news in the future. It could be a share buyback. It could be talking about something where they get in touch with a digital security to do a special dividend like they promised. The paperwork's going in for the audits on the 1-800 law firm. There's so many positive things going for the company. If I was a short seller here, I would just be panicking. I don't know how I would sleep at night. So I gave you some ranges today, 424, 438, 452, 475, and 496. They smashed majority of them. Same thing with finger motion, 572, 659, 721. Had an incredible day today. We'd like to see this trend continue. We'd like to see rising price, rising volume just off of volume analysis. So keeping it nice and simple, I'm looking at fib levels. Once it breaks that high, I will readjust to the all-time high, low to high. But currently for this frame, those are the fib levels I'm going off of. So I want to wrap the video up by saying thank you to Karen Finnerman today. We had an incredible interview. She was a pleasure to speak with. I hope we get another opportunity to deep dive into, content like this where we see predatory lending. There's so much more to talk about, but she was the only one that's reached out to me and wanted to hear from my perspective. So I really do appreciate that from you. It means the world to us. All we're trying to do is expose this fraud. It's been going on for so long, way longer than I've even been around, and to prove it right here with this Forbes article that it's been going on for decades. Okay, longer than most people here have even been alive. So it's crazy that the system is broken. We see Gary Gensler and these SEC enforcers saying that, we should be in the markets where we feel safe and secure and that we have an even playing field. Do you feel safe and secure? Do you feel like this is a fair and balanced market? I certainly don't. And we know that time after time, it could be major companies like UAL, it could be force protection, it could be cancer companies that do incredible work, head and neck cancer like CVM or Bluebird. It doesn't matter who it is, whether it's the biggest corporations or the lowest penny stocks on the market. These shorts go to work and they attack, and it's absolutely disgusting. So thank you guys so much for watching. I truly do appreciate the endless support. And as always, we'll see you in the next one.